India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC TV 18 Motilal Oswal studios in Mumbai.
Good morning, hello and welcome. You're with us on Bazaar Morning Call, and it's the morning after. You can see the much sort of anticipated and feared US sell-off has happened. Where do we go from here? That's the question. I'm Surabhi Upadhyay. With me is Nigel D'Souza, as always. We'll have Prashant joining in the next couple of seconds as well. Hi, Nigel.
Well, hi, Surabhi. Yesterday was a very, very weak trading session, and now, in fact, a lot of investors are getting a little bit nervous out there. But I'll tell you what, times like these, as we have been stating, they provide a bit of an entry opportunity. And I'll tell you what, this morning, what is positive is we have the RBI that's taken note of the problem and they're trying to do something about it. So I like to see that.
No, absolutely. I mean, and we'll talk about this because it's been a liquidity bazooka that's come in from the RBI. OMOs, VRRR, there are FX swaps that have been announced. But before that, just a word on what happened overnight. And we're talking about the big sell-off. And it was working its way through the system. The market was expecting it and anticipating it, and that's what happened. I mean, the fall on the Nasdaq was about 3%. And, if you look at the individual names, and we'll put some of them up on the screen, the cuts were, there you go. Those were the cuts. And this is the US tech sell-off that we're talking about. Nvidia made the biggest headlines, 17% down, wiping off about $600 billion in market capitalization. That's bigger than the market capitalization of companies put together, Chevron for one. This was the biggest headline. The question is, now what? What next? Is it done? Or is this sort of dislocating expectations and markets for the next couple of days? We'll get to that in just a bit. But first, let me say hello to Prashant as well. Prashant, what a night.
I think DeepSeek caused some deep cuts. Right? And I think that's the way to maybe just sort of contextualize this. But absolutely, that graphic shows you, right? And you said the Nvidia cut loss in market cap was greater than companies. I think more than countries. $600 billion. I mean, I think that's just some incredible numbers. It's the largest ever stock market loss. I mean, ever. So I think, it just kind of puts into context the extraordinary gains that names like Nvidia, etc., have seen. So just to quickly run you through, the last night's session. So it was basically a AI frenzied sell-off, which led U.S. markets sharply lower. I mean, I think. And of course, it's the Chinese startup DeepSeek's threat to US AI development, which was in focus. I mean, fears that maybe, American companies, American AI development companies are falling behind the AI race. Also kind of basically at the core of it calls into question the billions and tens and hundreds of billions of dollars that, large mega cap US tech companies have spent. If a Chinese startup can do it in, 1/10 the cost, what's the point of all these large investments? And Nvidia, which supplies the chip to be able to do all this sort of AI work, of course, got hit the largest amount. Now, a $600 billion erase in Nvidia, as we pointed out. And of course, on the indices, S&P was down 1.5%, Nasdaq down about 3% or so. I just want to say one thing. When you look at this, it was largely completely tech-focused sell-off. So despite the fact that we had such a large sell-off in tech, only about 30% of the S&P stocks ended lower. And I think that kind of, at the margin, is a bit of a silver lining. And the other one is that S&P 500's, that psychological level, which is 6,000, that was held, at least for last night. We left off at about 6,012. In terms of macro markets, the 10-year yield lost about 9 basis points, but that's largely a function of the risk-off sentiment out there. So nothing very much happened in the rates market. Oil was down 2%, and I think we left off at about just under $77 per barrel mark. This morning, by the way, there is some tariff talk as well to boot. Apart from all of this. So Donald Trump, the U.S. president, essentially is saying that he'll be placing tariffs on steel, aluminum, and copper, as well as semiconductors. These are comments made in early Asian trade, which I think we'll have to sort of take note of. As Surabhi said, RBI has announced those liquidity measures last evening. The clamor was rising, and if you ask sell-side economists, if you ask stock market investors, pretty much everyone, and this is leading up to the budget, everyone essentially was of the same view that, maybe there's not that much fiscal space, but there is monetary space in terms of easing. And it doesn't start with rates. It starts with liquidity and then slowly moves on to maybe, some rate cuts on the 7th of February. But we'll talk more about that, and Latha will come in as well. But this is important, especially for banks and what they can do for the overall liquidity environment. Now, the Nifty yesterday broke the previous low, made a new low. And I think that, of course, becomes the level to watch on the downside. But, you know, the daily Bollinger Band for the Nifty is also expanded a little bit. So 22,731 is that level. And that's about 100 points away from where we left off yesterday. That's kind of the support here. Upside, 40 hourly exponential moving average is 23,104. So about 200 points, 250 odd points away from where we left off yesterday. That would be the resistance. Similarly, for the Nifty Bank, by the way, the Nifty Bank was a relative outperformer yesterday. Here, the daily low Bollinger Band is 47,290. We left off at 48,065. And then the upside level is the 40 hourly average, which is 48,519 or so. So these are Nifty and Bank Nifty index levels. So you get a GIFT Nifty is, I think, indicating a higher start. You will get a higher start. And will we finally get that rebound, or will things be in a bit of a mix? It is a mix. It is a flux. Absolutely, it's a flux. There is no clear cut way forward from here. So if you're trading, you'll need to be mindful of all of that. We were due for a bounce even yesterday. It is just that you had this entire DeepSeek damage, which of course was leading US equity futures lower, and that was an indication which kind of continued to put pressure on Indian and other sort of equity markets as well. So, keep all of that in the back of the mind, but maybe some relief around here possible, and watch out for those first sort of hurdles to be crossed before the market can build and show some more repair and recovery from here on. For the Nifty, that level will be about 23,100 or so. Surabhi.
Yeah, absolutely. And, cues across Asia are anyway thin, so we're back to watching US futures to see what happens from here on. And the futures right now not expecting or indicating a very big pullback after the sell-off that happened yesterday that we discussed earlier on. Declines anywhere between 10-11% all the way up to 17-18% on US tech stocks thanks to the AI scare. In Asia this morning, there are lots of regional holidays because of the Chinese New Year. So China, Taiwan, South Korea all shut for Lunar New Year. Then there are, variable timings for markets like Singapore. They're either shutting early or many of them are closed. So Hong Kong, Singapore. Basically, it's like a black period across the region. The only major market that is giving us an indication right now is the Japanese Nikkei. And that market is slightly lower. And US futures are flat to mild negative at this point in time. So let's see how this goes. The Nasdaq futures have got a little bit of a tick of green on them. Let's move on to then cues that we have here at home, starting off with the fund flow data. Actually, even before the fund flow data, this is what I want to talk about, just to put the fall in context. Now, we all know that the pain in the mid-cap and small-cap space has been absolutely excruciating in the last couple of days. But if you look at the fall from the peak, then the mid-cap index is down about 15%. It's the small-cap and the micro-cap index, which is now just 3% away from the so-called bear market. 17% down on those indices, and the Nifty itself is down about 13%. Where will the buyers come in? That's the critical question. Well, there weren't any, not from the FBI fraternity yesterday. 5,000 crores of selling again happening yesterday, but the domestic liquidity is heartening. And, you really have to thank for all the SIPs that Nigel keeps talking about, the fact that that money, the domestic, mutual fund money, that still seems to be coming in. Now, on the stocks side, of course, bank stocks are going to be in focus because of what the RBI has announced, and more details on this in just a bit. The OMOs are going to be for 60,000 crores. The VRR auction is for 50,000 crores. And then there are the FX swaps that they've announced, which are running into almost $5 billion. So this should alleviate the immediate liquidity stress. Let's see. It's positive for banks. We will see if there is a pop anyway, some sense of recovery that's coming through. A whole raft of earnings coming in, and always a mixed picture as usual. I'll start with some of the better names. Tata Steel looked like an all-round beat. Let's watch out for this. For Federal Bank, the asset quality was fairly steady. There's some margin pressure, but it's not too much. I mean, it's pretty much par for the course, what we're seeing across the system. Coal India, the numbers seem quite okay. Nigel will tell us more about them, but it seems that the realizations are a little better off. Keynes could be today morning big discussion point, and we'll have the management joining in. The growth is 30%. The market is expecting 55% given the run-up in the stock. So will the market punish it now, given the valuations? Let's see. We'll talk about this. Today we have a full calendar as well. Bajaj Auto and Cipla are reporting. And let me throw in some insurance stocks here, because our colleagues in Delhi are reporting that the amendments to the Insurance Act, they could happen in the budget session itself. And if those amendments come through, then it'll be a raft of changes. I mean, insurers can offer all kinds of policies, life, general. So that composite license bit is being spoken about. A couple of other measures. You can have one agent selling, policies across multiple insurers, which could be a big sea change as well. So watch out for insurance stocks as well. plenty to keep us busy. But as long as, Nigel, the overall picture stabilizes, we don't have that free fall kind of a day like we had yesterday.
Well, that's the hope. And not that we're short of cues, but just to give you another cue today, we have the sensex weekly expiry as well that'll play out. So that'll add to the excitement. Just want to decode a couple of numbers here with regard to the FIs. What are they doing? They're selling in cash market, right? And they're buying stock futures as well. So it appears there's a reverse arbitrage at play. That is sell in cash and buy in futures. So that seems to be a strategy that's playing out. That's point number one. Just wanted to clear the air on that. The next one is the FI net short positions. There are plenty of debate out there. What's going on? There's been so much of covering, and yet the markets haven't bounced. Because from around 3.5 lakh contracts, it's come down to around 2.7 lakh contracts. But here's the important part. There could be a reason that maybe some of those positions are not getting rolled over, given that we have a big event later this week. So that's why you'll say that, well, the short percentage, in percentage terms, the shorts from around 17%, it's gone up to around 23. The long positions from around 17% has gone to around 23%, or the short position from 84% has come down to around 77%. But here's the catch. From the next series onwards, the lot size is going to change. So in contract terms, it appears that the contracts are coming down, but in value terms, actually, it's pretty much intact. So because of the change in the contract size, both on the Nifty and the Nifty Bank, that it appears that the shorts have covered out. That may not be the case, and that is not the case because the contract size itself is moving up. So in absolute terms, don't be deceived that there's already been shorts that have covered out. The FIs are still heavily net short, and we'll have to see how that plays out. So just keep that in mind as well. Moving on to the next data point, the PCR. That's come down to the lower end of the band. It's come down to around 0.76 because yesterday what we saw was there was a lot of put unwinding that was seen. That was puts that were written earlier, and call writing was very, very aggressive. 23,000 call was seeing some writing. The 22,900 call as well. But at the 22,600 put, there was a mix of activity. And if you put in these numbers and you want to get in the levels, you'll say 23,000 becomes a resistance zone, and any move towards those levels could be met with a lot of resistance. So that's going to be an important part. And going by the options data, the next level you're looking at is around 22,500. And all of the last few days, that support level is moving down. So now we're looking at 22,500 or thereabouts. The RBI has announced the liquidity measures. And if you had to bet on one sector to do well today, it'll have to be the banks and the financials, because tech will be in a bit of a flux. But this sector, should do the heavy lifting. If today we do need to see a bounce, then the Nifty Bank, financials, NBFCs, we'll have to keep an eye out on there. And that's the broad range that you're looking at on that one. Stocks that we're looking at, a few stocks have come out of the F&O ban. So they come up for you on the screen, ABFRL, Bandhan, Canfin Homes, as well as Dixon and LTF. All of them will be, in focus because they come out of the F&O ban. And the stock that I'm looking at besides the Nifty Bank, I'm looking at ITC. Last few sessions, actually, it's been a relative outperformer. You have the budget, which is obviously an important cue for them. And also, you have their results. So I'll keep an eye out on that one. In the last few sessions, it's not done much. But the Nifty is down close to around 4%. So that's a relative outperformer. I'll keep an eye out on that big boy.
All right. ITC is going to be in focus as well. Nigel, thanks for that. So let's kickstart the proceedings with the equity call of the morning. Christopher Wood of Jefferies says Greedenfear has had no exposure of late to hyperscalers in the Greedenfear global portfolio, but has been investing in AI picks and shovels themes since April 2023. He says, but with DeepSeek developments, Greedenfear will, ahead of the pending Chinese New Year, reduce holdings in the AI picks and shovels plays in various portfolios, precisely because of the potentially dramatic implications of the DeepSeek news. He says the investments in ASML and Hynix in the global long-only equity portfolio will be removed, while investments in Nvidia and TSMC will be reduced by 2 percentage points and 1 percentage point, respectively. He adds that investments in Alibaba, HDFC Bank and Brazil's bank Itaú will be reduced with a 4% weightage each. He says the last investment is simply to take advantage of a distressed valuation. So that's Christopher Wood, and he is tweaking his portfolio and cutting some weights in the erstwhile AISRs like Nvidia.
All right, well, some important view. This is Samiran Chakrabarti of Citi, who's weighing in now on the RBI's liquidity measures. Says that RBI announced liquidity infusion of 1.5 lakh crores via OMOs, forex swaps, and 56-day VRR. He still estimates durable liquidity deficit by end March if balance of payments does not move from deficit to surplus. Consequently, in their base case, Samiran sees possibility of further liquidity infusion by RBI in late February or early March, with quantum dependent on the BOP flow picture. He says these liquidity measures and emerging growth inflation dynamics buttress their view of 25 basis point rate cut at the February MPC, which is in the 7th. He adds market focus could now shift more towards addressing the quantum of rate cuts expected in this cycle, reiterates their bullish view on the 10-year bond yield on account of better supply and demand dynamics and rising expectations of a rate cut.